Hello, this is my Week 6 video journal on financial market effects on industry trends. So I chose the portfolio. A portfolio is a combination of asset classes such as various stocks and bonds to help the investor achieve the desired goals. In other words, it provides enough diversification so that you do not put all of your eggs in one basket. Portfolio weights. So in our reading, portfolio weights means the fraction of the total investment in a portfolio held in each individual investment in the portfolio. For example, if you have 200 shares of Apple, which are worth $200 per share, that would give you a total of $40,000. And if you had 1,000 shares of Coca-Cola, which were worth $60 per share, that would give you $60,000. That means that Apple represents 40% of your portfolio and Coca-Cola represents 60% of your portfolio, giving you a portfolio that is averaged at $100,000. So let's talk about the portfolio returns. In our reading, we learned that the return of a portfolio is the weighted average of the returns on the investments in a portfolio, where the weights correspond to the portfolio weights. So for example, if Apple earns a 10% return and Coca-Cola earns a 15% return, then 40% of the portfolio earns 10% and 60% of the portfolio earns 15%. Therefore, as a whole, the portfolio earns 13%. We could see that the 40%, which is represented by 0.40, is multiplied by 10%. And then the 60%, which is representing the Coca-Cola, is 0.60, and we multiply that by the 15% return, which gives us a total return of 13%. So calculating portfolio returns. So let's say you bought 200 shares of Apple at $200 per share, which gives us $40,000. You bought 1,000 shares of Coca-Cola at $60 per share, which represents $60,000. We already know that the Apple share represents 40% of your portfolio, Coca-Cola represents 60%. Let's say Apple stock rises to $240 per share, which gives you a $40 capital gain per share. And then let's say the Coca-Cola stock falls to $57, which gives you a $3 capital loss per share. So what is the new value? Well, if we take the 200 original shares of Apple and we multiply it by the new value, which is $240, we have a new value of $48,000. And then if we take the 1,000 shares of Coca-Cola, which now is only worth $57, the new value would be $57,000. So we take the new values of both Apple and Coca-Cola, which would be $48,000 plus the $57,000, and that gives us a new total of $105,000. In the end, we still have a gain of $5,000 or a 5% gain over the $100,000 of initial investment. So as with any investments or anything to deal with money, there's always ethical issues. So some of the ethical issues that came across my mind of portfolio returns would be the types of investments that you would make. So let's look, for example, if you truly believe that smoking cigarettes causes lung cancer, then would it be ethical for you to invest into a company such as Marlboro? Or if you have strong convictions on drinking alcohol and the effects that it may have on families, or drinking and driving, or all of the different downfalls of alcohol, would you choose to invest in a company that sells alcohol, even if the high profit margin were to be made? So knowing this, and if your financial advisor would even guarantee you 90% that you're going to make a profit, Knowing your own convictions, would you still make that investment? These would be the ethical issues that you would have to face. Thank God that we have the Bible to guide us and give us wisdom. The Bible does tell us wealth gained hastily will dwindle, but whoever gathers little by little will increase it. And we can find that in Proverbs 13:11. The references I used this week are Holmgren's Accounting Fundamentals of Corporate Finance.